the S&P 500 has gone positive for the year, but yet something like 300 or 300 and a quarter of those 500 issues are still below zero. They're still negative for the year. So I think that just reflects partly what you're saying, that the market lacks breadth, that most of the gains are accounted for by a handful of companies. I'm not sure what an investor is supposed to take away from that. On one hand, you say, well, it means that a lot of companies aren't participating. So as a stock investor, won't that make me want to buy the Microsofts and the Apples and the Amazons that are leading the market? Or is it like an opportunity to play for some kind of leadership rotation? I'm not sure what an investor should take away from it. But in another way of thinking about it, though, some of the criticisms of U.S. type of capitalism is that it lends itself, for various reasons, to monopolies, to like heavily concentration. If they're not monopolies, meaning one company dominates, maybe it's an oligopoly, where a couple companies dominate a certain space. And the U.S., in many ways, the U.S. has those kind of concentrations of different types of economic power. You think about the Apples or the Googles or the Amazons. And so I think this is going to be not so much an issue for investors in the near term, but I think it is an issue for regulators. In Europe, we know that. And I think that after the November election, it could have a change in the U.S. regulatory environment as well. So I would just be thinking about what the concentration of economic power means, policy making, and what it means for like liberty, that is personal freedoms to consume. And at the same time, thinking about, as an investor, do I really want to fade this move and try to like end the fangs when so many people have been trying it for so long and they still seem so powerful? That for many investors, think about what happened. The big shock, the big sell that takes place in March, and many people were like nursing those losses. And I think we have seen some like speculative froth in the market, but I think that we also have to put in a larger context. And that context, those considerations for me would include things like we're like well into our earnings season, and earnings have generally done a little bit better than many people expected. And secondly, next week we're going to get the first look at the second quarter U.S. GDP. And to your point, it's going to be a real body blow. I mean, estimates are around for a 34% annualized contraction. And yet the market and investors, we're not looking at Q2. Q2's over. We're looking forward. So what are we looking at in Q3? Well, the Bloomberg survey suggests a median forecast of about 18% growth, annualized pace. And even the more conservative model at the New York Federal Reserve is talking about a 14% growth in the current quarter. And so I think what's happening is that one is that the stock market is being lifted partly by optimism about a vaccine, partly about there's not really a lot of alternative investments. And then looking forward, we probably are, even though we've got the virus is having a flare up not only in the United States but Australia and Hong Kong, some parts of Europe. But I think that we're looking at not a shutdown, but some localized closures. And what it's doing is just shaving what could have been an incredible third quarter to just a good third quarter. I have been generally bearish on the dollar. A lot of people, like maybe even the consensus, has joined me in this bearish dollar outlook. And if the dollar is going to fall, people tend to like those commodities like gold and like oil. But the CRB index broadly has been doing a bit better as well. And so for me, it's partly my dollar bearish story. It's also, gold doesn't always look attractive when you can get high yields from other investments. But now that we have something like $14 trillion of negative yielding bonds, gold looks very attractive. And we're near multi-year highs, and I thought that we could get to 1,800, and now I'm thinking that maybe 2,000 is reasonable. I think the Fed is concerned. I think it's laying the groundwork for a move maybe in September or maybe early Q4. I think the Federal Reserve does want to do something more. I think that several of the Fed presidents that have spoken have expressed concern about maybe the stickiness of the employment numbers, those weekly initial jobless claims. Still over 1 million people in the U.S. are filing initial unemployment claims on a weekly basis. So I think the Federal Reserve is concerned. I don't think they do anything now at next week's meeting, but I do think they prepare the market for what I think is something like a yield curve control, which would be targeting some other rate, maybe a 3-year or 5-year yield. And the point here is not so much that rates are moving higher, In fact, because rates are low, they can cap it without having to spend much money. And the real purpose of it is under really a policy called forward guidance, trying to help the markets understand that from the Federal Reserve's point of view, they imagine interest rates will likely not rise for 2 years or longer. And so how to convince the market of this, and partly to target a very low yield on, say, the 5-year or the 3-year note. So I do expect the Federal Reserve to do more. I think they've been arguing that the federal government should be doing more as well. And as you know, that's one of the things that have been weighing on the dollar the last day or two, is some signs that maybe the bill might get delayed into early August, which is after some expirations of some of the current programs.